Here's a paradox that still confuses people decades later. In 1998, Russia was not the world's largest economy. Its stock market was small. Its currency barely traded outside its borders. And yet, when the Russian ruble collapsed, shockwaves ripped through Wall Street. Hedge funds imploded in New York. Pension money trembled in Europe. And the global financial system came within inches of a chain reaction collapse. How did a country many investors barely took seriously almost take down the world's financial plumbing? And why did so many of the smartest minds in finance fail to see it coming, even as the warning signs were flashing in plain sight? This story is not just about Russia. It is about confidence, debt, and a dangerous belief that risk can be engineered away. It is about how markets punish complacency. And it is about why crises rarely start where people expect them to, but almost always spread further than anyone imagines. To understand 1998, you have to rewind to the wreckage of the Soviet Union. When the USSR collapsed in the early 1990s, Russia inherited not just nuclear weapons and a seat at the United Nations, but an economy in freefall. Central planning vanished almost overnight. State factories lost subsidies. Supply chains disintegrated. Inflation exploded. Ordinary Russians watched their life savings evaporate as prices doubled, tripled, then multiplied again. The West offered advice, loans, and a vision. Liberalize fast. Privatize state assets. Let markets work. The promise was that pain would be temporary and prosperity would follow. What actually followed was chaos. A small group of insiders scooped up vast state assets at fire sale prices. Oligarchs were born. The government was weak, tax collection collapsed, and trust in institutions eroded. By the mid-1990s, Russia had stabilized just enough to convince global investors that the worst was over. Inflation was down from hyperinflationary levels. The ruble was pegged in a controlled band against the dollar. Western governments and the International Monetary Fund stepped in with financial support. On paper, Russia looked like a classic turnaround story. And Wall Street loves a turnaround story. Global investors were hunting for yield. Interest rates in the United States and Europe were relatively low. Pension funds, hedge funds, and banks wanted higher returns. Emerging markets promised exactly that. Russia began issuing short-term government bonds, known as GKOs. They paid eye-watering yields, sometimes exceeding 40% annually. The logic seemed irresistible. Russia needed financing. Investors wanted returns. The ruble peg appeared stable. The IMF stood behind the reforms. What could go wrong? Here is where the first illusion took hold. Those massive yields were not free money. They were a signal. Russia could not collect enough taxes to fund itself normally, so it borrowed short-term, rolling over debt again and again, paying old investors with money from new ones. It was not officially a Ponzi scheme, but it rhymed uncomfortably close. At the same time, Russia's economy was dangerously dependent on commodity exports, especially oil. When oil prices were strong, dollars flowed in. When oil prices fell, the budget bled. In 1997 and 1998, oil prices collapsed to levels not seen in decades. Russia's main source of hard currency dried up just as its debt obligations piled higher. Still, markets stayed calm. Why? Because investors believed in the peg. They believed the government would defend the ruble at all costs. They believed the IMF would not allow a default. They believed that modern financial models had priced the risk correctly. Then, Asia cracked. In 1997, financial crises erupted across Thailand, Indonesia, South Korea, and beyond. Currencies collapsed. Capital fled emerging markets. Suddenly, investors began asking uncomfortable questions about countries they had previously lumped together as high-yield opportunities. Russia, once exotic and exciting, now looked fragile and dangerous. Capital started flowing out. To defend the ruble peg, Russia burned through its foreign reserves. Interest rates were raised to crushing levels to keep investors from fleeing. The government issued even more short-term debt to survive another month, another week, another auction. Behind the scenes, policymakers were trapped. Devalue the ruble and risk instant inflation and political chaos. Default on debt and lose access to global markets. Do nothing and watch reserves vanish. Every option was bad. In August of 1998, the illusion finally shattered. The Russian government announced that it would restructure its domestic debt, impose a temporary moratorium on certain foreign payments, and widen the ruble trading band. In plain language, this meant default and devaluation. The ruble collapsed. Within weeks, it lost roughly 2/3 of its value. Banks failed. Ordinary Russians rushed to withdraw cash. Prices spiked. Years of fragile confidence evaporated overnight. For Russia, the crisis was devastating. But the truly shocking part came thousands of miles away. Global investors had not merely bought Russian bonds directly, they had woven Russia into a dense web of leverage, derivatives, and mathematical assumptions. One hedge fund in particular embodied this belief in controlled risk, long-term capital management. LTCM was not an ordinary hedge fund. It was run by legendary traders and Nobel Prize-winning economists. Its models assumed that price differences between similar assets would converge over time. They believed extreme market moves were statistically almost impossible, and they borrowed enormous sums to amplify tiny differences. When Russia defaulted, markets did not behave normally. Instead of small, contained losses, correlations spiked. Assets that were supposed to move independently all moved together. Liquidity vanished. LTCM lost billions in weeks. Its collapse threatened to drag major banks with it, because those banks were deeply entangled through loans and derivatives. This was the moment when the Russian ruble crisis stopped being a Russian story and became a global one. The Federal Reserve quietly orchestrated a private sector bailout of LTCM to prevent a cascading failure. Not because the fund deserved saving, but because the system could not survive its uncontrolled collapse. Think about that for a moment. A default by a government many Americans could barely locate on a map nearly froze the heart of global finance. Why did this happen? Because the system was built on assumptions that were never stress-tested against reality. Assumptions that governments would always prioritize debt repayment, that pegs would hold, that liquidity would always be available, that diversification would protect against extreme events. The Russian crisis exposed how fragile those assumptions were. In the months after the collapse, Russia's economy contracted sharply. Poverty surged. Trust in reforms collapsed. Yet, in one of history's cruel ironies, the devaluation eventually made Russian industry more competitive. Imports became expensive. Domestic production revived. Oil prices later rebounded. By the early 2000s, Russia was growing again. But global finance did not truly learn the lesson. Fast forward to later crises, and the pattern repeats. In 2008, it was subprime mortgages in the United States, supposedly diversified and sliced into safe tranches. In the Eurozone crisis, it was sovereign debt treated as risk-free until it suddenly wasn't. In emerging market scares, it is always the same story. Yield, chasing, leverage, complacency, shock. Even today, the echoes are unmistakable. Governments carry massive debt loads. Investors reach for yield in riskier corners. Complex models promise control. And global markets remain tightly interconnected, meaning stress in one place can propagate at lightning speed. The shocking truth is not that Russia defaulted. Countries default throughout history. The shock is how little margin for error the global system had built in, how a single broken link could threaten the entire chain. So what does the 1998 Russian ruble crisis really teach us? First, high returns are rarely free. When yields look too good to be true, they usually reflect hidden fragility. Russia's bonds were not mispriced by accident. They were screaming warnings that investors chose to ignore. Second, pegs, guarantees, and institutional backing do not eliminate risk. They often concentrate it. When confidence breaks, defenses fail all at once. Third, Global markets are only as stable as their weakest assumptions. Complex systems do not fail gradually. They fail suddenly, violently, and in ways models struggle to predict. The warning is uncomfortable but necessary. The next crisis will not look exactly like 1998. It never does. But the behaviors that create it are already familiar. Overconfidence, leverage, the belief that this time is different. If history is any guide, the real danger is not what everyone is watching. It is what everyone has already decided is safe. If you want to understand modern financial risk, you cannot just study the winners. You have to study moments like the Russian Ruble crisis, when certainty collapsed and hidden connections were exposed. If this story challenged how you think about markets, debt, or global stability, consider subscribing. We explore the forgotten crises, the uncomfortable patterns, and the lessons history keeps trying to teach us. Because the past does not repeat itself exactly, but it echoes, and those echoes are getting louder.